Have you noticed something unusual happening inside the world's most powerful central bank? While most investors are focused on one simple question, whether the Federal Reserve will raise interest rates or finally begin cutting them, a much bigger story is quietly unfolding behind the scenes. That story could reshape expectations for gold, silver, the US dollar, bond markets, and even the global economy over the next several months. Imagine a Federal Reserve that not only changes interest rates, but also changes the very way it communicates with financial markets. Imagine fewer policy meetings, fewer public signals, and a greater emphasis on long-term economic direction instead of constant short-term reactions. Now combine that with several senior Federal Reserve officials openly suggesting that inflation remains too high and that interest rates may actually need to rise further. Suddenly, what looked like a routine monetary policy debate becomes something much more significant. Welcome to Macro Bullion. On this channel, we don't chase headlines, we connect them. We analyze how central bank decisions, macroeconomic trends, government policies, and commodity markets fit together to reveal the bigger picture. Because in today's financial world, no single headline tells the whole story. Over the past few days, a series of important developments has emerged from the United States, each carrying implications far beyond Wall Street. One of the most discussed ideas came from former Federal Reserve Governor Kevin Warsh, who suggested that the Federal Reserve should consider holding fewer monetary policy meetings each year. At present, the Fed meets 8 times annually to assess economic conditions and decide whether interest rates should change. Warsh believes that reducing the number of meetings could shift market attention away from short-term speculation and back toward long-term economic fundamentals. At first, this may sound like a simple procedural adjustment, but in reality, it could significantly alter how investors interpret monetary policy. Over the years, every Federal Reserve meeting has become a major market event. Traders spend weeks analyzing inflation data, employment reports, GDP growth, and speeches from policymakers, all in an effort to predict the Fed's next move. Every meeting influences expectations across stocks, bonds, currencies, and commodities. If the number of meetings were reduced, markets would receive fewer official policy updates throughout the year. That could make each remaining meeting much more important while increasing the value of economic data released between meetings. Investors would likely pay even closer attention to inflation reports, labor market figures, consumer spending, manufacturing activity, and other key indicators because those data points would become the primary guide to future policy. This discussion is taking place at a particularly sensitive moment. Inflation has cooled significantly compared with the multi-decade highs seen after the pandemic, but it has not yet returned to the Federal Reserve's long-term objective of around 2%. While progress has been made, policymakers remain cautious because inflation has proven more persistent than many expected. That caution became even more evident when Richmond Federal Reserve President Thomas Barkin described the current policy environment as a close call. In other words, he acknowledged that it remains uncertain whether existing interest rates are restrictive enough to bring inflation fully under control. His comments reflected a broader debate developing within the Federal Reserve itself. Even more striking were remarks from several other policymakers who argued that recent inflation data could have justified additional interest rate increases. Among them was Minneapolis Federal Reserve President Neel Kashkari, who suggested that if inflation fails to continue moving lower, a series of further rate hikes cannot be ruled out. These statements reveal something important. Investors often think of the Federal Reserve as speaking with one voice, but in reality, it is made up of policymakers with different interpretations of the same economic data. Some believe inflation is gradually coming under control, while others worry that underlying price pressures remain too strong. That internal debate matters because it influences future policy decisions, and those decisions ultimately affect everything from mortgage rates and business investment to gold, silver, and the value of the US dollar. And this is where the story becomes even more interesting, because despite keeping interest rates at historically elevated levels, the American economy has shown remarkable resilience. Instead of slowing sharply as many economists expected, growth has continued, consumers have kept spending, businesses have continued investing, and financial markets have remained surprisingly strong. The question now is no longer whether the economy can survive higher interest rates. The real question is whether that unexpected strength is becoming the Federal Reserve's biggest challenge. That question goes to the heart of today's macroeconomic story. Normally, when a central bank raises interest rates aggressively, borrowing becomes more expensive, consumer demand begins to slow, businesses delay investment, and inflation gradually falls back toward its target. It is a process economists have observed through multiple economic cycles, yet this time, the outcome has been far less predictable. Despite one of the most restrictive monetary policy environments in years, the U.S. economy has continued to expand. The labor market has remained relatively healthy, household spending has proven more resilient than expected, and many companies have continued reporting solid earnings. Instead of collapsing under higher financing costs, large parts of the economy have adapted. For the Federal Reserve, this creates a difficult policy dilemma. Strong economic activity is generally positive because it supports employment, business investment, and income growth. However, an economy that grows too quickly can also keep inflation alive. When consumers continue spending and businesses continue raising prices without a significant decline in demand, inflation becomes much harder to eliminate. This explains why several Federal Reserve officials remain cautious. Their concern is not that inflation is accelerating dramatically, but that it may be settling at a level above the Fed's long-term objective. If inflation becomes permanently embedded in wages, services, and business pricing, returning it to target could require even tighter monetary policy later. One area receiving particular attention is the services sector. While prices for many physical goods have stabilized compared with the sharp increases seen during the pandemic recovery, service-related inflation, including housing, insurance, healthcare, hospitality, and labor-intensive industries, has remained considerably more persistent. These sectors are closely linked to wage growth, and wages generally adjust more slowly than commodity prices. This means policymakers cannot simply focus on one month's inflation report. They must determine whether the broader trend is genuinely improving or whether inflation is merely slowing temporarily before accelerating again. At the same time, financial markets continue trying to stay one step ahead of the Federal Reserve. Every inflation release, employment report, retail sales figure, manufacturing survey, or consumer confidence index immediately changes expectations about future interest rates. Sometimes, markets react before policymakers even speak. If inflation comes in slightly above expectations, investors begin pricing in the possibility of tighter monetary policy. Treasury yields often rise, the US dollar strengthens, and equity markets can come under pressure. On the other hand, weaker inflation data tends to fuel expectations that the Federal Reserve may eventually reduce borrowing costs, supporting stocks while easing pressure on precious metals. This constant repricing explains why market volatility has remained elevated even without dramatic changes in official policy. But the United States is not the only country dealing with this challenge. Around the world, central banks are facing similar questions. Some have already started easing monetary policy, believing inflation has been sufficiently contained. Others remain cautious, worried that easing too soon could undo years of progress. Colombia recently surprised investors by keeping its benchmark interest rate unchanged while signaling that its fight against inflation may not yet be over. Although Colombia represents a much smaller economy than the United States, its decision reflects a broader global trend. Central banks everywhere are trying to balance economic growth with price stability, and many remain reluctant to declare victory over inflation too early. Adding another layer of complexity is the political environment. Economic policy today extends far beyond interest rates alone. Governments are increasingly using industrial policy, infrastructure investment, trade measures, and strategic resource development to strengthen long-term economic competitiveness. Fiscal policy and monetary policy are becoming more interconnected than at any point in recent decades. This changing landscape is forcing investors to think differently. A few years ago, simply following Federal Reserve meetings was often enough to understand market direction. Today, that is no longer sufficient. Investors must also monitor government spending, geopolitical developments, trade negotiations, supply chain security, and technological investment because each of these factors can influence inflation, growth, and market sentiment. In other words, the global economy is entering a phase where multiple forces are shaping financial markets simultaneously, and nowhere is that more visible than in the precious metals market. Because while economists debate inflation and policymakers discuss interest rates, gold and silver investors are asking an entirely different question. How will all of these macroeconomic shifts ultimately affect the world's most important safe haven assets? To answer that question, we first need to understand why gold and silver respond so differently to the same economic news. Although both are precious metals, they do not move for exactly the same reasons. Gold is primarily a monetary asset. Investors turn to it when they are looking for protection against uncertainty, inflation, currency weakness, or financial instability. Silver, on the other hand, plays two roles at the same time. It is both a precious metal and an industrial commodity, meaning its price depends not only on investor sentiment, but also on the strength of the global economy. That distinction has become increasingly important in today's market. But when Federal Reserve officials suggest that interest rates may remain higher for longer, investors immediately begin adjusting their expectations. Higher interest rates generally push Treasury yields upward, making government bonds more attractive because they offer a better return with relatively low risk. As yields rise, holding a non-interest-bearing asset like gold becomes less attractive in the short term. This is one of the main reasons gold sometimes struggles even during periods of elevated inflation. But that relationship is not always straightforward. If investors believe higher interest rates will eventually slow economic growth or increase financial stress, demand for safe haven assets can quickly return. History has repeatedly shown that gold often regains strength whenever markets become concerned about recession risks, banking instability, geopolitical conflict, or unexpected economic shocks. Silver reacts to many of the same forces, but industrial demand adds another dimension. Unlike gold, silver is used extensively in solar panels, semiconductors, medical equipment, electric vehicles, telecommunications, and advanced electronics. As countries continue investing in renewable energy, digital infrastructure, and next-generation manufacturing, long-term industrial demand for silver continues to grow. This creates an interesting balance. A stronger global economy supports industrial demand for silver, while economic uncertainty supports investment demand. In certain periods, both forces can work together, allowing silver to outperform many other commodities. However, during periods when manufacturing slows and interest rates remain elevated, silver can experience greater price swings than gold because both sources of demand come under pressure simultaneously. Another important piece of the puzzle is the US dollar. The dollar remains the world's primary reserve currency, and nearly all major commodities, including gold and silver, are priced in dollars. When the Federal Reserve maintains relatively high interest rates, international investors often move capital into U.S. assets, seeking higher returns. That additional demand tends to strengthen the dollar. A stronger dollar creates a natural challenge for precious metals. If the dollar appreciates against other currencies, buyers outside the United States must spend more of their local currency to purchase the same ounce of gold or silver. That can reduce international demand, placing temporary pressure on prices. The opposite is also true. Whenever markets begin anticipating future interest rate cuts, the dollar often weakens. A weaker dollar generally makes precious metals more affordable globally, providing additional support for bullion prices. This is why experienced macro investors rarely look at gold in isolation. Instead, they monitor the relationship between interest rates, treasury yields, inflation expectations, real yields, currency markets, and central bank policy. Each variable influences the others, creating a constantly evolving financial landscape. Yet monetary policy is only one side of today's story. Another major transformation is taking place through government policy. Around the world, governments are becoming increasingly focused on economic security rather than simply economic efficiency. The pandemic exposed vulnerabilities in global supply chains, while geopolitical tensions highlighted the strategic importance of critical minerals, energy independence, and domestic manufacturing. These concerns have encouraged many governments to rethink how they manage natural resources. Recent discussions surrounding President Donald Trump's support for expanding Arctic mining projects reflect this broader shift. Rather than relying heavily on imported strategic minerals, policymakers are placing greater emphasis on increasing domestic production of resources essential for advanced technology, defense systems, renewable energy, and industrial manufacturing. This represents much more than a mining story. It signals a broader transition toward economic nationalism, where countries seek greater control over the resources considered vital to long-term competitiveness. For commodity markets, these developments could have lasting consequences. New mining projects require enormous capital investment, environmental approvals, infrastructure development, and years of construction before meaningful production begins. Even when governments accelerate approvals, increasing supply is rarely immediate. As a result, demand can continue growing much faster than supply for extended periods, creating structural support across parts of the commodity sector. And that raises another critical question. If governments are competing for strategic resources, businesses are investing heavily in artificial intelligence, and central banks are still fighting inflation, what kind of global economic system is beginning to emerge? That is where the story moves beyond monetary policy and into the future of the global economy itself. The answer may be that the global economy is entering a completely different phase from the one investors became familiar with over the last 2 decades. For many years, globalization focused on reducing costs, expanding international trade, and allowing companies to build supply chains wherever production was cheapest. That model helped keep inflation relatively low and supported rapid economic growth across many regions. Today, however, priorities are changing. Governments are placing greater importance on economic security, technological leadership, and access to strategic resources. Instead of relying entirely on global supply chains, many countries are encouraging domestic manufacturing, investing in critical infrastructure, and securing long-term supplies of minerals that are essential for future industries. This shift is not happening in isolation. It is taking place alongside rapid advances in artificial intelligence, clean energy, semiconductor production, and digital infrastructure. These industries all have one thing in common. They require enormous amounts of capital and vast quantities of raw materials. That is why recent discussions surrounding Arctic mining have attracted attention far beyond the mining industry itself. The proposal is viewed by many analysts as part of a broader strategy to strengthen domestic access to critical minerals that will power future technologies. Whether it is lithium, copper, nickel, rare earth elements, or silver, these resources are becoming increasingly important as governments compete to build stronger industrial bases. From a macroeconomic perspective, this represents a significant change. For years, monetary policy was considered the primary tool for influencing economic activity. Today, fiscal policy is playing a much larger role. Government spending on infrastructure, industrial incentives, technology development, and resource security is becoming a powerful driver of investment. This means markets are no longer reacting solely to interest rate decisions. They are also responding to long-term policy initiatives that could reshape entire industries. Artificial intelligence provides another example of this transformation. Investment in AI continues to accelerate as businesses race to improve productivity, automate operations, and strengthen competitiveness. Technology companies are investing billions of dollars in data centers, advanced processors, cloud infrastructure, and software development. While this wave of investment has supported economic growth and corporate earnings, it has also raised new questions about sustainability. Analysts are beginning to ask whether current levels of AI spending can continue indefinitely or whether the pace will eventually slow as companies seek stronger returns on their investments. For investors, this debate is important because technology has become one of the largest contributors to market performance. If AI investment continues expanding, it could support economic growth, employment, and industrial demand for key commodities. If spending slows, financial markets may need to adjust expectations for future earnings and growth. This is another reminder that today's economy is being shaped by multiple forces at once. Political decisions, technological innovation, fiscal policy, monetary policy, energy markets, and commodity supply chains are all becoming increasingly interconnected. A policy announcement in Washington can influence mining investment in Alaska. A change in Federal Reserve expectations can move Treasury yields within minutes. Rising energy prices can affect manufacturing costs worldwide. Advances in artificial intelligence can increase demand for electricity, data centers, semiconductors, and industrial metals. Each development influences the next. For investors, this creates a more complex environment than previous economic cycles. The days of relying on a single indicator are largely over. Successful macro analysis now requires connecting developments across different sectors rather than viewing them independently. This is exactly why professional investors spend so much time studying relationships instead of isolated headlines. They ask how stronger employment affects inflation, how inflation influences Federal Reserve policy, how interest rates affect the US dollar, how the dollar impacts commodity prices, how government investment shapes industrial demand, and ultimately, how all of these factors combine to influence financial markets. When these relationships are viewed together, a clearer picture begins to emerge. The global economy is not moving toward a simple period of uninterrupted growth or an unavoidable recession. Instead, it appears to be entering a phase of slower but more strategic expansion, where governments, central banks, and private companies all play increasingly important roles in directing economic activity. For precious metals investors, this means volatility is likely to remain a permanent feature rather than a temporary exception. Gold and silver will continue responding to inflation expectations, interest rates, currency movements, geopolitical developments, and industrial demand, all at the same time. The challenge for investors is no longer finding information. The challenge is identifying which information matters most. And that brings us to the final question every investor is asking today. What is the most likely path for the Federal Reserve, the U.S. economy, and precious metals over the months ahead? And what signals should investors watch before making their next move? That final question is exactly where every investor's attention should now be focused. The truth is that no one, not even the Federal Reserve itself, can predict the future with complete certainty. Every policy decision from this point forward will depend on incoming economic data. That means the next inflation report, the next employment numbers, consumer spending, wage growth, manufacturing activity, and even business confidence surveys could all influence the direction of monetary policy. The Federal Reserve has made one message consistently clear throughout this cycle. It is prepared to remain patient. Policymakers are no longer following a fixed roadmap. Instead, they are evaluating each new economic report before deciding whether current interest rates are restrictive enough to bring inflation back toward their long-term objective without causing unnecessary damage to economic growth. For investors, this means expectations will continue changing almost every month. If inflation continues to move lower while the labor market gradually cools, the Federal Reserve may eventually gain the confidence to begin easing monetary policy. Such a scenario could reduce pressure on Treasury yields, weaken the US dollar, and provide a supportive environment for gold and silver. Lower borrowing costs could also improve financial conditions for businesses and consumers, encouraging broader economic activity. However, there is another possibility. If inflation remains stubborn, consumer demand stays strong, and wage growth continues supporting higher prices, policymakers may decide that interest rates need to remain elevated for longer than markets currently expect. In that environment, Treasury yields could remain relatively high, the dollar could stay firm, and precious metals may experience periods of short-term volatility before establishing a clearer long-term trend. There is also a third scenario that deserves attention. Economic growth could begin slowing more rapidly than expected while inflation remains above target. This would create one of the most difficult environments for any central bank because policymakers would face two competing objectives: supporting economic growth while continuing the fight against inflation. History shows that these periods often produce the highest levels of uncertainty across financial markets, as investors struggle to determine which risk deserves greater attention. Regardless of which scenario ultimately unfolds, one principle remains constant. Markets do not move because of opinions, they move because expectations change. Every time investors receive new information, whether through inflation data, employment figures, GDP growth, Federal Reserve speeches, or geopolitical developments, those expectations are adjusted. That constant reassessment is what creates opportunities as well as volatility. For gold investors, the long-term investment case continues to rest on its role as a store of value during periods of uncertainty, inflation concerns, and financial instability. For silver, the outlook remains closely connected to both monetary conditions and industrial expansion. Continued investment in renewable energy, electric vehicles, advanced electronics, artificial intelligence infrastructure, and strategic manufacturing could provide meaningful structural demand over the coming years. At the same time, silver's dual role as both an industrial and precious metal means it is likely to remain more volatile than gold during periods of changing economic expectations. Looking beyond bullion, the broader message is equally important. The global economy is no longer driven by a single force. Central banks, government spending, industrial policy, technological innovation, geopolitical competition, and commodity security are all shaping the next phase of economic development. Investors who focus on only one headline risk missing the much larger trend unfolding beneath the surface. This is why independent macroeconomic analysis has never been more valuable. Instead of reacting emotionally to daily market moves, successful investors study the relationships between inflation, interest rates, currencies, commodities, and economic growth. They recognize that every headline is just one piece of a much larger puzzle. As we move through the remainder of the year, keep your attention on the indicators that truly matter: inflation, labor market conditions, consumer spending, manufacturing activity, bond yields, and the Federal Reserve's communication. Together, these signals will provide the clearest roadmap for where financial markets may be heading next. If you enjoyed this analysis and want more in-depth coverage of the Federal Reserve, gold, silver, the US dollar, global commodities, and the macroeconomic forces shaping financial markets, make sure you subscribe to Macro Bullion and turn on notifications so you never miss our latest reports. Now, I want to hear from you. Do you believe the Federal Reserve's next move will be another rate hike, an extended pause, or the beginning of a rate-cutting cycle? And more importantly, where do you see gold and silver heading over the next 6 to 12 months? Share your thoughts in the comments below. I'd love to hear your perspective. Finally, remember that this analysis is based on publicly available economic information and verified macroeconomic developments available at the time of writing. Financial markets can change rapidly as new data emerges, so always verify the latest official figures before making any investment decision. This content is intended for educational purposes only and should not be considered financial advice. As always, do your own research. Thank you for watching Macro Bullion, and I'll see you in the next macro analysis.